Number 1. AOL buys Time Warner. In January 2000, at the height of the dot-com boom, AOL announced it would buy Time Warner for $182 billion. It was the largest corporate merger in U.S. history at the time. AOL was a dial-up internet giant. Time Warner owned cable networks, film studios, and magazines. Together, they were supposed to dominate the future of media. 2 months after the announcement, the Nasdaq peaked. Then it crashed. The dot-com bubble burst, and AOL's inflated stock value collapsed almost overnight because the entire deal was paid in stock. The new company's worth disintegrated with it. The two cultures clashed violently. AOL was fast and internet native. Time Warner was slow and traditional. By 2002, the combined company posted a staggering $98.7 billion loss, still the single worst annual corporate loss in U.S. history. Investor Ted Turner estimated he personally lost around $8 billion, roughly 80% of his wealth. In 2009, the companies finally split apart. What started as a vision of the future became a masterclass in how not to do a deal. Number 2. Microsoft's Nokia nightmare. In September 2013, Microsoft CEO Steve Ballmer announced a $7.2 billion deal to buy Nokia's phone business. The idea was simple. Microsoft needed a foothold in the smartphone market dominated by Apple and Google. Nokia was once a titan of mobile phones, but by 2013, the race was already over. iOS and Android had divided the world between them. Satya Nadella, then Microsoft's cloud chief, voted no internally. He reportedly said Microsoft was chasing its competitors' taillights. Ballmer pushed the deal through anyway. The acquisition closed in April 2014. Almost immediately, things fell apart. Nokia's culture and Microsoft's culture had no common ground. The Lumia phones failed to gain market share. In July 2015, new CEO Satya Nadella took a $7.6 billion write-off, almost the entire purchase price. 7,800 employees lost their jobs. In May 2016, Microsoft sold off the remaining mobile unit to HMD Global and Foxconn for just $350 million, a $7.2 billion bet, gone in under 3 years. Number 3. Google ditches Motorola. In May 2012, Google bought Motorola Mobility for $12.5 billion. The main prize was Motorola's massive patent portfolio, roughly 17,000 patents covering mobile technology. Google was deep in legal battles over Android and needed protection. But running a hardware company turned out to be far harder than expected. Between mid-2012 and late 2013, Motorola racked up nearly $2 billion in operating losses for Google. The smartphone hardware business had paper-thin margins of around 2 to 3%. Google tried building phones in a Texas factory. That failed due to high labor costs. By January 2014, Google announced it was selling Motorola to Lenovo for just $2.91 billion. That was a loss of nearly $10 billion on paper. Google kept most of the patents, which had been the real goal all along. Some analysts argue it was a calculated move, not a disaster. Others say Google simply overpaid and never had a real plan. Either way, the world's biggest search company bought and dumped an iconic phone brand in under 2 years. Number 4. Quaker kills Snapple. In November 1994, Quaker Oats paid $1.7 billion for Snapple. Wall Street immediately said they overpaid by at least $1 billion. Quaker had just turned Gatorade into a billion-dollar brand using massive supermarket distribution. They wanted to repeat that trick with Snapple. The problem Snapple was the opposite of Gatorade. Its entire identity was built around quirky TV ads, devoted fans, and independent distributors supplying small delis and bodegas. Quaker stripped all that away. They forced Snapple into big-box retail chains and standardized the marketing. The brand lost its soul overnight. Pepsi and Coca-Cola jumped into the market with competing drinks. Snapple sales tanked. Quaker's CEO and several senior executives resigned in disgrace. After just 27 months, Quaker sold Snapple to Triarch Beverages for $300 million. That worked out to a loss of $1.6 million for every single day they owned the brand. Triarch later turned Snapple around and sold it to Cadbury Schweppes for about $1 billion. Someone always makes money, just not the person who destroys the thing first. Number 5. eBay ruins Skype. In September 2005, eBay bought Skype for $2.6 billion. Analysts were baffled. Skype generated only $71.8 million in revenue that year. eBay was paying a staggering 36 times its annual sales. The justification was that Skype's voice technology would let eBay buyers and sellers communicate directly. That synergy never materialized. Skype simply continued operating on its own, completely disconnected from eBay's auction business. In 2007, eBay took a $1.4 billion write-down on the purchase. They also got tangled in a bitter legal dispute with Skype's original founders, who had kept ownership of the core underlying technology. By 2009, eBay sold a 70% stake in Skype to a private equity group for $2.75 billion. eBay kept a 30% stake, which Microsoft later bought for $2.55 billion in 2011, so eBay eventually recovered some value from the mess. But the logic of the original deal never held up for a single day. A video calling app had no business being inside an online marketplace. It was one of the most obviously mismatched acquisitions in tech history. Number 6. Daimler divorces Chrysler. In May 1998, German automaker Daimler-Benz and American car company Chrysler merged in a $36 billion deal. It was billed as a merger of equals. It was not. Daimler quickly took control, and the cultural clash was immediate and brutal. German executives expected long hours, rigid hierarchy, and a focus on quality. American executives had a looser, faster, cost-cutting culture. Key Chrysler executives left the company in waves. Chrysler, which had been profitable before the deal, began losing money. By 2000, losses had reached $1.3 billion. In 2006, Chrysler posted a $1.5 billion loss, and Daimler announced it was looking to sell. In May 2007, Daimler sold 80.1% of Chrysler to private equity firm Cerberus Capital for $7.4 billion, a fraction of what had been paid 9 years earlier. Chrysler filed for bankruptcy in 2009 during the financial crisis. It was eventually absorbed by Italian automaker Fiat. One of the biggest industrial mergers in history ended in bankruptcy court. Number 7. MySpace's Murdoch disaster. In July 2005, Rupert Murdoch's News Corp paid $580 million to buy MySpace. At that moment, MySpace was the most visited website on the internet, bigger than Google. Murdoch reportedly claimed he could have sold it for $6 billion just 1 month after buying it. He did not sell. Instead, News Corp focused on monetizing MySpace with aggressive advertising. The site became slow, cluttered, and overrun with spam. Meanwhile, Facebook was quietly adding features, a cleaner interface, and a real name culture. Users started leaving MySpace in massive numbers. By 2008, Facebook had overtaken it entirely. News Corp executives rotated in and out trying to fix things. Nothing worked. In June 2011, News Corp sold MySpace to digital ad firm Specific Media for just $35 million. That was roughly 6% of what they paid for it. Murdoch publicly admitted it was a huge mistake, and that they had mismanaged it in every possible way. Every executive involved with the deal eventually left the company. Number 8. HP destroys Autonomy. In October 2011, Hewlett-Packard paid $11.1 billion to acquire Autonomy, a British software company. HP was desperate to pivot away from hardware and into enterprise software. The deal was supposed to transform the company. Just over 1 year later, in November 2012, HP announced an $8.8 billion write-down, nearly the entire purchase price, wiped in 12 months. HP accused Autonomy's former management of accounting fraud, alleging they had inflated revenue by booking hardware sales as software licenses. The company referred the case to the U.S. Department of Justice, the SEC, and the U.K. Serious Fraud Office. Autonomy founder Mike Lynch denied everything and fought the allegations for years. In 2024, a UK court ruled that while some fraud had occurred, HP had substantially exaggerated the losses and had overpaid in the first place. HP's own due diligence had been deeply flawed. Either way, billions were destroyed, executives resigned, lawsuits piled up, and HP's reputation took a lasting hit. A deal meant to save the company nearly sank it instead. Number 9. WeWork's SoftBank trap. WeWork was founded in 2010 as a co-working space company. By early 2019, SoftBank had valued it at $47 billion, making it one of the most valuable startups on Earth. SoftBank had poured in over $10 billion in total. Then WeWork filed to go public in August 2019. The prospectus revealed staggering losses, $900 million in just the first half of 2019 alone. It also revealed a chaotic corporate structure, and CEO Adam Neumann personally profiting from building leases he controlled. Investor confidence evaporated overnight. The IPO was shelved in September 2019. Neumann was forced out. SoftBank launched a $8 billion rescue package to keep WeWork alive, taking control of the company. The Japanese giant posted an operating loss of $6.4 billion in 1 quarter, largely due to WeWork and Uber. SoftBank alone ultimately lost more than $14 billion on WeWork. In November 2023, WeWork filed for bankruptcy. A company once valued at $47 billion collapsed with a market cap of just $45 million. What started as a vision of transforming office space ended as the worst venture capital bet in modern history. Number 10. Twitter becomes X. In October 2022, Elon Musk completed his $44 billion acquisition of Twitter. The deal had been one of the most chaotic in corporate history, with Musk trying to back out, ending up in court, and finally going through with it. Within his first week, Musk laid off roughly half of Twitter's workforce. Hundreds of engineers and content moderation staff were let go overnight. Major brands began pulling advertising. They were concerned about content moderation and brand safety on the platform. In July 2023, Musk rebranded Twitter as X, replacing one of the most recognized logos in tech with a plain letter. By mid-2023, Fidelity's internal estimates valued X at less than 25% of the $44 billion Musk paid. UK financial filings showed X's British revenue dropped by over 66% in the year following the takeover. Musk's own engineers and executives publicly described internal chaos. In March 2025, Musk merged X into his AI company xAI, valuing X at $33 billion. That was already a significant discount from what he paid. Whether X eventually recovers remains one of the most watched questions in business.